What if I told you that when you buy the S&P 500, you're actually buying 400 stocks that are dragging down your returns as much as it's dragging down Winston back there? And right now, there are just 10 companies that control 40% of the entire S&P 500. That's the highest concentration since the dot-com bubble crashed in 2000. So while everybody thinks they're diversified with 500 stocks, they're actually betting everything on just a handful of tech giants. And what happens when those giants tumble? Your diversified portfolio crashes with them. Today, I'm going to show you exactly why this is happening, why it's dangerous, and most importantly, what smart money is doing about it right now. I'm Felix Prehn, that was Winston back there, and I'm an ex-investment banker who's seen how Wall Street really works from the inside. I'm also founder of the Goat Academy with over 20,000 students and co-founder of TradeVision.io, where we give you access to data you've never seen. And our mission is simple. I've dedicated my career to teaching regular investors how to beat Wall Street at their own game. And what you learn in the next 20 minutes is, well, you'll discover the hidden maths behind the S&P 500's problem, why sector rotation is creating a massive opportunity right now, and a specific ETF strategy that's already beating the market by over 5% just this year. So stick around, because I'll also share 3 sectors that could explode in the coming months, including one that just saw a 26% single day gain, and it's just getting started. So let me break down what's really happening with the S&P 500. The top 7 tech stocks, your Apple, Microsoft, NVIDIA, Amazon, Google, Meta, and Tesla, they now make up 30% of the S&P 500. And that's the highest concentration since, well, 2000. And we know what happened when the dot-com crash wiped out trillions. So think about it. If you put $1,000 into the S&P 500, maybe you're buying an ETF like VU or one of those, well, actually what happens is that $300 of that goes straight into these guys. So why does this matter? Well, you have performance dependency. These stocks basically generate 2/3 of all the returns, and the rest of the S&P 500, all the other 493 companies, give you, well, very, very little. Now, Wall Street expects these mega tech companies to continue to over-deliver and grow their profits by a whopping 11% per year. And all the other stocks will grow by 8% a year. So what does that leave you with? Well, which stocks do you think are going to go up? So you are not actually diversified. You are just making a massive bet on 7 companies. And then you own 493 bits of rubbish. Let me give you an example. NVIDIA is now 8% of the entire S&P 500. One company. If NVIDIA drops, say, 20%, the entire sector goes down, even if the other 400-something companies are doing great. And that's exactly what happened in 2000 when Cisco, Microsoft, and Intel were dominating the index back then. Now, my intention here is not to scare you. My intention is to make you aware of a problem, of an issue, and give you a solution. But the real problem I've seen from literally reviewing thousands of students' portfolios is that people don't know when to sell. What do people do? Well, they sell the winners early, and the losers, they're still holding on to them, right? If you still got one of those stocks from 2020 hanging around in your portfolio, it's still down 70%. A lot of people do. And Wall Street doesn't do that. Otherwise, they wouldn't be getting the returns they're getting. And there is a very simple framework you can actually learn, a simple set of rules to when to sell and how to automate that. And I want to teach you that. But I'm not going to be able to put that into this video because it would make this like an hour long, and you probably haven't got that. That's all we're here for. So I'm going to do something better for you. I'm going to run a live training session where I will teach you that at felixfriends.org/training. It's free. You can sign up for it down below. It's happening like Thursday, 9 p.m., I think, Thursday, 9 p.m. Eastern time. So grab yourself a free seat to that and learn when to sell. It's the lowest hanging fruit for all investors. It's not about finding the greatest stock in the world. It's just keeping the profits when you've got them and getting rid of the losers when they start to become losers. Now, there's a huge opportunity right now. It is called sector rotation. Sector rotation happens when money moves from one sector, usually an expensive sector, to a cheaper one. Why? Because money is seeking the highest returns. And we're seeing a massive shift from high growth tech to more defensive sectors, more value sectors. Why is it happening? Because investors are getting a little nervous about tech valuations, 50 times, 100 times, 500 times PE. And there are three sectors right now that I think are creating the biggest wealth opportunity right now, while tech is sort of, doing so-so. First one here, oil and energy. I'm going to give you ETFs on this one. If you want to get some actual individual stock ideas, subscribe to the channel. I put those out every couple of days as well. So tech hasn't done too great this year. Oil stocks are actually doing very nicely. Plus they pay a dividend. And they're pretty cheap compared to the money they're making. Now, if you bought something like XLE, which is an ETF, that alone pays a 3.4% dividend. I'm not telling you to buy it. This isn't financial advice. This is hopefully the beginning of your research, not the end. Because, well, if it's the end, then you're going to make some really silly decisions because you don't fully understand it yet. But energy stocks are still cheap, in my humble opinion. Now, as the economy grows, travel increases, oil demand will surge, and just quite frankly, energy demand is just growing. But everybody hates oil stocks because of, well, global warming. But that's exactly where contrarian investors should start to pay attention. And the money is flowing into this. And maybe you don't believe me on that. Well, have a look at a stock chart and you'll start to understand why. The second sector I'm loving right now is called biotech. Sounds balmy, sounds crazy, sounds risky, but hear me out. It's actually down this year, right? While the market is up like, 15% or something? So it's massively underperformed the market this year and last year. So after years of decline, biotech is showing some signs of life. And AI has got something to do with that. Drug discovery is getting faster. We've got lower interest rates, which are a big factor for biotech companies. And Pharma is starting to buy the smaller biotech companies because they want those drugs. So biotech is where tech meets healthcare, the ultimate growth story, aging population, all that kind of stuff. Yeah, it's high risk, but there's potential for a massive return here. Obviously, you got to have your risk management down because that's the most important thing as an investor. And I'll teach you that if you come and join me at felixprehn.org/training. Now, third, we have the marijuana explosion. There is an ETF called MJ, massive gains, really, really explosive gains. And a lot of that's going to do with just politics. Trump potentially being more open to legalizing cannabis. And yeah, you got individual stocks like Tilray, like Canopy Growth, they're bouncing a lot. But this one's speculation. So the upside could be enormous, but you only want to invest what you can definitely afford to lose. This is a little bit, this is like a high risk one, right? I call it gambling. That's maybe a little harsh if you've got proper risk management and exit rules and so on. But this is probably the highest risk one we have here. Now, I'm going to give you the lowest risk one next. But for now, let me know in the comments which of these three sectors most interest you. Drop a comment down below. Just put the one that you are most interested in right now. But let me give you the simple solution. Now, there is something that literally I am buying, and it is called the S&P 100. So it's basically like the S&P 500 without the 400 bits of rubbish. The 100 largest companies in America. So we're no longer being dragged down by those 400 rubbish ones. We just get the best 100. And OEF is up very nicely. It's beaten the S&P 500 by 5% so far this year, by about, I want to say 16% the last 5 years. So why does it work? Well, you get exposure to the companies that actually drive the returns, but you get rid of the dead weight of the 400 that barely contribute anything at all. So the math behind OEF's success is very simple, which is the S&P 100 ETF. There are probably others too. I'm not, again, selling a particular ETF. None of these videos are ever sponsored. I couldn't care less which ETF you decide to buy. And of course, it's always your decision anyway, because you're going to do some research. But we are no longer paying for those 400 stocks that don't do anything. And that's important. It still gives you diversification because it's still across sectors. It's relatively inexpensive at 0.2% expense ratio. Now, I grant you something like VU, which is the S&P 500, I think has a 0.03% expense ratio, which is definitely cheaper. But so far, the outperformance seems to justify it. And they also pay a little bit of a dividend. They pay about a 0.9% dividend, I think, last time I checked. So similar risk profile, but potentially better returns. Only the most profitable and the strongest companies are in there. Now, you're still going to have some concentration risk. So the top 10 are still going to contribute the most, and then the next 90 will do okay, but at least you got rid of the 400. At least you got rid of the 400 that don't do anything at all. So again, I'm not telling you what to do, but just some thoughts here. It could be a core position or part of your core position, right? To replace the S&P 100. And then you can, if you want to be more active, you can look at other sectors like oil and energy, like biotech, like, marijuana and so on. But if you want to be just the lazy dollar cost averaging investor, don't do it in stocks. Don't even do it in sectors because it's going to hurt you. You're going to do it with something broad, S&P 100 or S&P 500. You want a broad index fund. If you're just blindly buying every month and you care not one bit for what you own or what the market's doing or where the Wall Street money is flowing or any of that good stuff, then just buy an ETF, please. That's the most important thing, right? So what have we learned? Well, we've learned the concentration risk of the S&P 500. We learned that 400 of those stocks basically do nothing at all. We learned that the S&P 100 might be in a solution to that. That's pretty easy. So what do you want to do? Well, you're going to research some S&P 500 replacements, what might be right for you. Consider some small sector rotation positions. Again, consider that carefully. Do you understand them? Do you understand how the money is flowing? Can you read a stock chart? Do you have risk management set up? All that good stuff, because that's essential. And stay patient. And if you got some value out of this video, come and join the live training at felixfriends.org/training, and I will literally teach you when to sell. And one of my students, former students, graduate really, it's a friend by now, came to visit me the other day, and we had breakfast together, and I asked, he was telling me how well he was doing, and there's a whole gang where he is in Arizona, and they're all doing really, really well, which is amazing, and makes my heart jump and skip a beat, because that's exactly why I do this. And I said to him, well, so what's really helping? And he said, well, you showed me how to sell, or rather you showed me where the sell button is. And that's a very, very important thing, because taking profits and cutting losses is actually where the money is made. And people are just so obsessed with finding the next Tesla, or the next NVIDIA, or the needle in a haystack, that they just don't realize there is a very low hanging fruit that anybody can do. You don't need to be smart. You don't need to be very good at it, but it's going to be better than what you're doing right now, in all likelihood. You enjoy this video, come and join me. Share it with some people who might benefit from this bit of wisdom as well. All the best. If you hold any dollar assets, your savings, your 401ks, your bonds, what I'm about to reveal could either protect your wealth or leave you financially devastated. A Russian economic advisor just exposed what he claims is America's secret plan to eliminate $37 trillion in debt overnight.